Good day, and welcome to the Anatomy of a Recession second quarter 2021 update. My name is Vinay Nadkarni, and I work on the business development team at ClearBridge Investments. I'm proud to be hosting today's call with our investment strategists, Jeff Schulte and Josh Chandler. Wanted to quickly explain our format for the call today. There is a lot going on in the markets these days, and with the NFL draft just finished and the NBA playoffs coming up, we scheduled our comments in 4 quarters or quadrants on key topics that Jeff and Josh will address. Those topics are economic outlook, key upcoming market considerations, inflation, and the big one that we're getting the most questions from clients on right now, which is inflation. Jeff and Josh will hit those points over about a 30-minute period, and then we have some pre-submitted questions. And please know that you can submit questions throughout the presentation via the chat feature. We'll try to get through as many of these questions as possible, and we'll have our client representative get back to you if they were unable to address on the call. Before I hand it over to Jeff and Josh, I want to note that ClearBridge is an authentic active manager, solely focused on fundamental equities, offering concentrated but balanced equity solutions with ESG integration across our investment platform. We now manage $184 billion in assets at the end of March. Without further ado, I'll hand it over to Jeff and Josh. And Jeff, I think you're going to go first.
I will. Thanks, Vinay, and good morning or good afternoon, everybody. Thank you so much for joining the second quarter institutional update for Anatomy of a Recession. And if you were with us in the first quarter coming into the year, you'll remember that we were much more optimistic than consensus on U.S. growth prospects. We had felt that GDP growth would be closer to 6% this year, while consensus was near 4%. But after a robust first quarter and a bigger than anticipated stimulus package, consensus is more in line with our thinking. But there was a slow patch that we experienced in the middle of the first quarter in February with the polar vortex hitting broad swaths of the U.S. And some were concerned about a double-dip recession, but we weren't, because the ClearBridge Recession Risk Dashboard was still flashing a very strong green color and continuing to strengthen beneath the surface. And over the course of April, we've had 3 indicator upgrades. Job sentiment has moved from red to yellow, wage growth has moved from red to yellow, and jobless claims has moved from yellow to green. Now, talking about each one of these a little bit more in more depth, if you look at job sentiment, what we're really looking for is for more respondees to say that jobs are plentiful than jobs that are hard to get. And over the course of April, saw the largest monthly jump in jobs plentiful responses in the survey's 54-year history. Also, jobs that are hard to get responses posted their second consecutive monthly decline. I think that this is going to be a trend that continues. At present, we have in the U.S. at 7.3 million job openings, which is already above pre-COVID levels, and it's nearing the peak in job openings that we saw in 2018. So it wouldn't be a surprise to me as we move through the second quarter and into the third that job sentiment will ultimately be green. Moving over to wage growth, really what we're looking for in wage growth is for wage growth to come down. Higher wage growth is usually associated with higher inflation, profit margin pressure, and a hawkish Fed. And if you remember back coming out of the pandemic, you saw a big spike of wage growth due to mix shift issues as a disproportionate number of the lower earning workers were laid off in hospitality and leisure. And as we get to reopening and we have a re-engagement with hospitality and leisure, you're going to see a disproportionate number of hires with lower earning workers in these industries, which is going to drive wage growth lower and ultimately, in our view, probably to a green color sometime over the next couple of quarters. And the last one is jobless claims. Now, jobless claims is an interesting case study because over the last 6 months, we should have turned jobless claims green. But the reason why we haven't is because the dashboard is a combination of art and science. I say that because 95% of the indicator changes are based on the model and the threshold that we've set. However, there are 5% of the changes that require our human judgment and collective wisdom in unique circumstances. And with jobless claims jumping on a weekly basis to over 6 million job losses at the peak of the pandemic, it's come down dramatically over the course of the last 12 months. However, throughout the course of 2021, jobless claims have been in a range from 700,000 weekly job losses to 900,000 weekly job losses. Now, if you look back prior to COVID, the most jobs lost in a week ever was back in 1982 at 695,000. So we didn't feel comfortable making jobless claims green until we were clearly below levels associated with deeper recessions. So if you look at the last 4 weeks of claims, they're in the mid 500,000 range, and today's came out at 498,000. So we've decided we are past peak numbers in jobless claims, and we felt much more comfortable moving it over to green. But nonetheless, as it stands today, we have 9 green and 3 yellow signals. But I wouldn't be surprised as we go through a very robust second and third quarter that we're going to have the strongest dashboard reading in the model's history, which goes back over 60 years. Now, talking about our economic outlook, back in January and similarly to today, it all was founded on the idea that the U.S. would reach herd immunity sometime in the late part of the second quarter. And once herd immunity was reached, it was going to unleash a tsunami of consumer spending. And you can see here that total excess savings compared to pre-COVID levels have reached $2.15 trillion. And when you reach herd immunity, you're going to have revenge spending, deferred gratification. You're going to see much higher economic activity. And if you look at wage growth, in March, it came in at a very elevated 9.8% level. Just as a reminder, the stimulus that went out because of March's package, half of that was delivered in March, half of it was delivered in April. So we're expecting another very strong print for retail sales in April. But we do think that services spending is going to pick up dramatically to help, again, increase economic activity over the next couple of quarters. And you saw this large increase of savings because of the inability to spend, but also because you saw a stimulus tidal wave in the U.S. The stimulus package that we saw was unrivaled in modern times. And to put it in perspective, policymakers provided the U.S. economy $5.3 trillion worth of fiscal stimulus over the last 13 months, which is a little bit over 25% of GDP. This is about 1.5 times the amount of the total stimulus that was provided during the last 5 recessions combined. You put it differently, the total economic stimulus passed over the last year has amounted to over $43,000 per household. Maybe from a historical perspective, the total outlay to fight the COVID war was higher than the total outlay spent to fight World War II in today's dollars. So we're in unrivaled territory here. And with the March stimulus package, it makes it official that there's going to be more fiscal support for the economy this year than last year, even though you've seen almost a 9% drop in the unemployment rate. The other part of the thesis was that we're going to see a much faster labor market recovery. And it was because you've had a very high share of the jobs that were lost in COVID-sensitive industries. And versus peak payroll back in February of last year, out of the 8.4 million jobs that were lost, 6.6 million, or over 75% of them, are in COVID-sensitive industries. So when you have a re-engagement with the services side of the economy, you're going to see much faster job creation than you typically experience. And if you look at March's job creation of 916,000, 73% of those were in COVID-sensitive industries. And with an expectation of close to 1 million jobs coming out in tomorrow's payroll report, we would expect a similar dynamic. But nonetheless, you're going to see much faster job creation than what you've historically seen during economic recoveries. You're also going to see much faster wage growth. You can see here there's been a very big divergence between the wage growth that you saw in this cycle versus the global financial crisis, because during this recession, it was distinctly a low-income recession. At the peak of the pandemic, 68% of all the jobs that were lost were in low-wage industries. During the global financial crisis, 50% of all the jobs that were lost were in middle-income jobs. So you've seen a nice V-shaped rebound to wages, and I think that this is going to obviously continue as the economy tends to heal. But the key takeaway from the last 2 slides is that you're going to see stories of a decline in the fiscal impulse later this year, a fiscal cliff, if you will. But I think that's going to be more than offset by the wage and salary growth that we're going to see as jobs are created at a very rapid pace. And the last part of the economic outlook really centers around an inventory restocking cycle. We talked about this last quarter, but after 3 months, we're actually closer to the beginning of that inventory restocking cycle than the end, although there has been a significant effort to restock. If you looked at first quarter GDP, it came in below consensus expectations, but the miss was mainly due to a 2.6% drop from falling inventories. But as you move to Q2 and Q3, inventories are going to have to be rebuilt, and that's going to be a nice tailwind to GDP. Also, the Fed Senior Loan Survey just recently came out, and it revealed that banks are beginning to ease their standards to lending to businesses, also ease their standards on mortgages and also credit cards and auto loans. But easing their standards to businesses is the more important one, because I believe we're on the cusp of a really strong industrial CapEx cycle. Companies are going to want to do a CapEx boom because they have improving expectations and a better outlook for the economy. Business surveys are starting to show this. There's less uncertainty compared to the last 4 years, which were plagued because of the trade war. You're going to have greater public investment. The $2.2 trillion American Jobs Plan should support private investment. And also, you're going to start to see onshoring of supply chains because the trade war and the pandemic revealed vulnerabilities in the U.S. supply chain. So with banks having a ton of excess liquidity right now and a lot of capital to meet the demand, I think that this is going to unleash a very strong CapEx cycle, which is not only good for economic activity, but it's going to be good for productivity growth in the U.S., which is going to help keep inflation down. So putting all of these pieces together, consensus expects the best growth this year since 1984, but this isn't just a one-year phenomenon. They're expecting the best growth next year since the year 2000. Now, we're a little bit more optimistic than consensus still, even at this point. We think real GDP growth probably comes in closer to 7% this year and 5% next year. But the key takeaway is that over the course of 2021 and 2022, at the end of next year, the U.S. economy will be anywhere from 16 to 20% larger than it was coming into this year. And you don't see rapid growth like that. And that's a key reason why markets are up so much, but it's going to be a key reason that can help drive markets further ahead from where they've come from. But if you think about the economic experience that we've seen in the market experience, it's going to be a little bit different this year than last year. Last year was characterized as a market that went straight up, minimal volatility, very, very strong returns. And this is the typical experience in the first year following a bear market low. But it's important not to get too defensive, because in the second year following a bear market low, you still have above average market returns with an average return of 12.4%. However, it's a choppier experience. The max drawdown that you see in year two is 10.3%. But the important consideration here is that even though we have a strengthening economy, you're going to have a rising but choppy market. But don't get too defensive, because if you look at that second year off the low column, which is the third one in, 100% of the time, the markets have had a positive return. But again, I think one of the key questions that we've been struggling with internally at ClearBridge, and we've been talking about, is market leadership. And where was market leadership going to come from at this point in the cycle? And we've been obviously had leadership with growth and defensive leading for most of April, but we feel that you still want to have that cyclical and value exposure in your portfolios at this point, and there's more upside for that trade. And if you look on the chart here on the left-hand side, versus the market peak last year through to the Pfizer announcement, which was a positive efficacy data back in the early part of November. Large outperformed small, growth outperformed value. Since that Pfizer announcement, you've seen it flip-flop. Smalls outperform large and values outperform growth. But what I find is noticeable here is that values outperformance of growth is a fraction of growth outperformance versus value. So we do feel like there's more of a catch-up trade there. Looking over to the right, that's just a decomposition of how that market performance was made, how much of it was earnings, how much of it was multiple expansion, and not surprising, a lot of the value outperformance that you've seen here recently was indeed from multiple expansion, as they anticipate much stronger earnings as the economy reopens. Thinking about cyclical exposure, which is the combination of materials, energy, industrials, and financials. If you want more cyclical exposure, you want to move down the market cap structure. So small cap would obviously be the best area to get the most cyclical exposure. Also, the same thing can be said with value as well. But you have seen a move into the cyclical value trade here over the last couple of weeks. And I believe it's the key reason for this rotation back into the trade was the fact that the U.S. finally crossed the 40% threshold of Americans getting a vaccine. Now, this is if you looked at the path of Israel, which is one of the first countries to reach herd immunity, once they passed that 40% threshold, you saw a huge leg down in cases. And the U.S. passed that 40% threshold very recently. They're at 43%. You're already starting to see cases leg down, but I wouldn't be surprised if they plummet dramatically over the course of May and June, which is really going to supercharge that cyclical/value trade as well. Other thing I'll mention on value versus growth, value typically has outperformed growth on average for about 33 months historically. We're in month 8, so we're pretty early on in that process. Value has also outperformed growth on average by about 60%, and we're around 20% at the moment. Usually also you see it move over to value, growth over value when profits growth peaks as well, and that's probably not going to come until the fourth quarter of this year. So we do think that there's a little bit more juice in this trade. But one thing that we really examined very closely is the fact that if you have a peak in manufacturing PMI, that usually means a peak in that cyclical trade and a rotation into defensives and growth. You can see here that every time you've had an manufacturing PMI peak, utilities, healthcare, staple, real estate, tech, and discretionary were your leaders. And in March, you had a print for manufacturing PMI of 64.7. We just got April's number, and it was at 60.7, so it dropped by 4 points. So typically, this would be a great environment for defensive and growth leadership. However, I think that you need to think about this in a different perspective because the relationship between manufacturing PMI, GDP, and cyclicals is different this time. I hate using those 4 words, but it is different this time because the Fed is not tightening anytime soon. And in contrast to most of these peaks, the Fed is continuing to give its $120 billion worth of QE per month, and the cycle isn't ending, and it's not about to experience a significant tightening of financial conditions. So there's really no reason, in my opinion, to kind of rotate into that higher quality defensive positioning quite yet. The other reason is that we expect revisions for the value cyclical camp to strengthen as we move through the next couple of quarters. Analysts historically underestimate cyclical earnings potential and, more importantly, operational leverage. With the U.S. economy growing again almost 20% over the next 2 years, that's going to be a key driver, and Josh is going to talk about that here in just a second. And the last reason is that although we're having peak levels of economic activity right now, it's more of a reflection of easy comps as we lap last year's reopening rather than an upcoming deceleration. And it wouldn't be a surprise to us if you see peak levels of GDP in Q3 rather than Q2. And this is a very different environment when you have high but stable economic growth rather than high and then declining. So with that, I'm going to move it over to Josh to talk a little bit about what these different regimes mean for equity market leadership. So Josh, take it away.
Thank you, Jeff. As Jeff was just saying, we tend to think about the ISM in terms of both level and direction, and taking it a step further, not just if it's high or low, but we want to look at is it high or very high. If you look on the right side of the page, we show market returns based on ISM in a 3x3 grid. And we look at high, medium, low, rising, stable, or falling. I think the consensus view right now is that if we're going to end up in the lower left box, a high but falling regime. But given everything Jeff laid out over the last couple of slides on the strength of the economy, we think it's more probable that we end up probably in the middle left box in the near term, a high and stable environment, and then probably move towards the dead center as we move into 2022. What this means is that we might have some pockets of volatility. It should be an overall environment where equities continue to grind higher. If you take a look at sector returns across this 3x3 grid, when we're in that middle left and also the dead center boxes, you typically see cyclical leadership with energy, industrials, and discretionary standing out on the positive side, and defensive groups like staples, communications, and utilities lagging, consistent with what Jeff laid out over the last 2 or 3 slides. If you turn to the next slide, another key concern a lot of investors that we talk to have is around corporate margins, which are potentially coming under pressure from 2 key areas. The first is rising input costs with commodities up so much. However, if you take a look historically, higher commodities have been positively correlated with EBIT margins, with a slight lag. In my view, this is driven by 2 things. First is operational leverage, which Jeff was just talking about, which means that when rising commodities typically occur in an environment where economic growth is accelerating. This allows businesses we're going to see improving revenue growth in such an environment, meaning they're able to spread their fixed costs out across a larger sales base. The second driver is that companies often do a pretty good job passing through costs over time. This can take different forms. We often see surcharges with things like airlines tacking fees onto tickets when fuel prices rise, but can also be things like shrinkflation, just when a potato chip company puts 1 or 2 fewer chips in every bag, or they use a little bit less salt in the recipe or things like that. But at the end of the day, they still charge you the same amount for the bag of chips. In effect, companies find ways to maintain or even improve margins by raising prices, whether explicitly or implicitly. And as these sorts of fees or changes typically don't get reversed all that quickly if commodity prices later come back down. The second worry on inflation tends to be around wages right now. And I think this is probably the larger risk. We're hearing a lot of companies say over and over through time that people are their greatest asset. And to be honest, they're not just trying to make their employees feel good or be nice. SG&A which is where wages sit in income statement, is the largest line item for most service businesses, and in some cases for manufacturers as well. When you look at wage trends over the last year, there's one industry that stands out in the chart at right. That's leisure, where wages have really lagged almost every other sector throughout the pandemic and are now catching up. There's been a plethora of headlines in Wall Street Journal, New York Times, financial media of your choice about restaurant wage hikes right now. But I think that this is more of a unique dynamic within that sector as opposed to something that's much more broad-based. And you can see that in the red and gray lines showing the other industries as well as service industries overall. A final concern a lot of investors have brought up lately is around taxes, with the stimulus bill and accompanying tax increases being proposed over the last couple of weeks. It is still very early days, and the actual bills haven't even been drafted yet. The legislative process is really just getting going. It means a lot is going to change over the next few months, but for now, on the individual side, most DC experts seem to think that things like capital gains and dividend taxes aren't going to go up as much as proposed. A lot of this has to do with how CBO, Congressional Budget Office, math works. They assume that looking at capital gains, for example, as the rate charged goes up, as the tax rate goes up, people put off some amount of gains. They delay realizing gains to avoid that. It means that when you kind of run through the model, there is a magic number where lower realizations can actually offset the increase in rates, and you end up collecting less tax according to the model. It works out to be something like 26, 27, or 28%, depending on exactly who you talk to, which is a level well below what's been proposed. On the corporate tax side of the equation, a big focus right now is on global taxation. You probably heard the acronym GILTI, which stands for Global Intangible Low Income Tax. This is really a problem in the U.S. much more than elsewhere because we have more large multinationals relative to other countries, and we also have a lot of loopholes in our global taxation system. The goal of the administration seems to be to close some of these loopholes, but in a way that's not going to sacrifice competitiveness on a global stage. If you look at the right-hand chart, you can see that as a percent of corporate taxes as a percent of GDP, the U.S. collects far lower rate than almost any other developed country. In fact, our closest neighbors on this basis are Turkey and Italy. It means that we can likely come up a little bit and still remain competitive. In terms of the effect, if you turn to the next slide, this is going to hit companies in communications, technology, and healthcare to a much greater degree, as these are the areas where GILTI is more applicable. They can ship patents to low domicile tax countries and license them back to the U.S., whereas it's pretty hard to do that with a grocery store or a power plant. You can't really pick up and move those things around, have them operate from a low tax jurisdiction. It means that businesses like financials, energy, and consumer tend to be more sensitive to changes in the headline corporate rate. So depending on how everything plays out over the next few months, and again, it's very early in this process, a lot is going to change as we move through the legislative process, but tax changes could drive some leadership rotation within the market. Ultimately, when it comes to the headline rate, a couple of key senators have said that they think something lower than proposed, maybe 25% or so, sounds good. It's still going to represent a hit to earnings, maybe 8% if we do move from 21 to 25%, but the rate's still going to be well below where it was in 2017 before tax cuts. With that, I'm going to turn it back over to you, Jeff.
Great, thanks, Josh. And while Josh is talking about key concerns for the market, I think another key concern that people have is rising interest rates. And if you remember, again, last time that we did this call, about 3 months ago, much more optimistic on where a 10-year Treasury was going to trade. And in fact, coming into the year, I felt it was going to be at 1.75%, and the gray bars were the sell-side forecast for the 10-year Treasury in January. And at 1.75%, it was pretty lonely territory. I can tell you as a strategist, being that far out of consensus, it is very uncomfortable. But I was optimistic on the U.S. economic expansion, and obviously we've seen the 10-year Treasury reflect this acceleration here over the last 4 months. And as we have seen this change, you've seen the distribution move over to the right. But what I think is really interesting is that out of the 58 analysts right now that give sell-side forecasts, only 7 of them believe that the 10-year Treasury will be above 2% at the end of the year. And I think that's a pretty complacent view. One of the reasons why I think it's a complacent view is that usually you see the yield curve steepen much further. So in the last 3 economic expansions, the 10-year has expanded to 2.5%. Now today, We've retraced about 60% of those levels. It's at 1.5%, but this would suggest further steepening as the economic cycle matures from here. And with the Fed penning the short end of the curve, the steepness is going to come from a higher 10-year Treasury. But the move higher is going to be much more nuanced, much more of a stair-step type of experience rather than a stampede higher like we saw in the first quarter. And a key reason for that view is that U.S. Treasuries look attractive to international investors on a currency hedge basis. Now, when international investors buy the Treasury, they don't want to deal with moves from the dollar, so they like to hedge out the dollar and just get the yield pickup. And you can see here that the 10-year Treasury in the U.S. versus a 10-year Japanese government bond gives you a positive yield pickup way north of 1%. And typically, once you get past that 1% threshold, it's attracted not only Japanese buyers, but also European buyers as well. So again, we think rates are going to go higher, but it's going to be much more of a grind. But higher rates isn't necessarily a bad thing for financial markets. I think that's a bit of a misconception. It's very common to see interest rates rise in anticipation of increased growth of inflation because the economy is shifting to a new equilibrium for both prices and interest rates. Taken alone, it really doesn't represent financial tightening and thus require a negative market reaction. Any higher impact of rates on autos or housing, for example, it really needs to be taken in context of the potential job growth that you're going to see, wage growth, demographics, home prices. Interest rates are only a fraction of that overall puzzle. And given today's robust macroeconomic backdrop, financial conditions have actually eased a little bit as you've seen rates rise due to not only a lot of the stimulus that we've seen, but the continued lack of intervention and help actually from the Fed. And the way that you can tell financial conditions are getting easier or tighter is by looking at that blue line. That's the real 10-year Treasury yield. Right now, you're getting a real 10-year Treasury return as of today of around 85 basis points negative. During the global financial crisis, you saw real rates at plus 50 basis points, and that was a time where you saw slow growth, weak housing, rising savings, a Fed that wasn't willing to overshoot a 2% inflation bogey. So I do think that this is one of the reasons why you're going to see the 10-year Treasury rise, because this is a very different dynamic, and investors really aren't being compensated for the inflation risk that they're taking. It's much too conservatively priced at this point. But nonetheless, if you're looking at real yields right now, they are extremely negative, and that's going to be a good sign. So 10-year Treasuries rise from today to call it 2.25%, which is our expectation, eventually settling in around 2%. Because of how easy financial conditions are, it doesn't necessitate a negative market return. And in fact, if you look at all the times where the 10-year Treasury has risen by 1.5% or more, markets have had a very positive experience. This goes all the way back to 1962. The second column all the way to the right there, you can see that the S&P 500 during rising rate environments has seen an average return of 11.9% with a percent time being positive of 85%. Russell 2000 did even better at 16.7% average return. It was positive 78% of the time. So our expectation is rates will rise on the long end of the curve, but it's not going to be detrimental to equity market returns, but it certainly will determine leadership, which again is in line with our cyclical value call. Now, the last thing I'm going to talk about here before opening up the Q&A is probably the question that all of you have on your mind, which is inflation. We're going to see an inflation scare in the U.S. for a variety of different reasons. First off, we're going to lapse the year-over-year weak inflation prints from last year's shutdown, so that's naturally just going to make inflation look higher. We're going to see service sector price pressure as the tsunami of demand that I talked about before overwhelms a constrained supply situation. And also, with a lot of the globe still fighting COVID, you're going to have global supply chain bottlenecks. This is obviously very evident in semiconductors. But the key is that the scare is primarily a U.S. phenomena due to the large fiscal response that we've had here locally, and also the very strong economic recovery and how close we are to attaining herd immunity. And the global divergence is best evident in the prices paid component of manufacturing PMI. You can see that prices paid increased in Europe and the rest of the world, but it's literally off the charts here in the U.S. This is a similar message that you would see with inflation and GDP. There's a very good relationship between GDP, but it just leads inflation by 18 months. Given the compressed nature of this cycle, and the reopening as kind of that trigger. Inflation, instead of lagging 18 months, is going to lag 3 months. But the key question for everybody here is whether or not this is transitory, as the Fed would say, or whether or not this is something more structural in nature. So to examine this, we talked about the bear case for inflation, the bull case for inflation, what the markets are pricing, and then ultimately, what are my views? So let's talk about the bear case for inflation first. And the bear case for inflation really centers around labor market slack. We went back and we looked at every economic expansion for the last 65 years in both high inflationary regimes, which is that light gray line, and low inflationary regimes, which is the blue line. And in both regimes, you actually see disinflation for the first 3 to 4 years of that economic cycle because of the abundance of labor market slack. And it really should suggest that we temper our expectations on how high inflation can go in the near term. But to do a quick exercise, how quickly could we get rid of the labor market slack, get to full employment, and have some wage growth and thus inflation? So the peak employment in the U.S. before we went into the COVID recession was 152 million jobs in February of last year. Assuming we never went into a recession, would have created 2 million jobs last year, would have created 2 million jobs this year. So by February of 2022, theoretically, the U.S. economy should have 156 million jobs. Put in economic jargon, that would be the closing of the output gap of employment. Right now, we're at 144 million jobs, so we're 12 million jobs away. That means that we'd have to create more than 1 million jobs per month for the next year in order to get to quote-unquote full employment. We're going to get 1, maybe 2 of those prints, but to get 12 straight, I think, is a very unlikely scenario. So even if we cut that in half to 500,000 jobs per month, we want to be back to full employment or trend employment until the middle part of 2023. And even that number is pretty aggressive, because if you go back to the global financial crisis, you were creating a little bit over 200,000 jobs per month. So I think more realistically, we'll get back to full employment probably around 2024, at which point labor slack won't be an issue and you have the potential for some higher inflation numbers. But this is a key component of that bear case for inflation. The other part of the equation is demographics point to a muted inflation backdrop for the U.S. over the next 20 years. There's been a very strong relationship with the fertility rate in the U.S. leading CPI by 22 years. Captured the high inflationary 70s and the last 40 years of disinflation. And by looking at this metric, it would suggest that CPI is going to increase from 2 to 3% over the course of this decade as the millennials enter into their peak spending and earnings years, but then it's going to go back down to 2% in the following decade. So the bear case is obviously U.S. demographics aren't very strong, and also, of course, labor market slack being abundant. Let's talk about the bull case, and the bull case is multifaceted. First aspect of it is deglobalization. More and more countries are looking inward. They're looking to reshore domestic manufacturing capabilities, and you see that global trade as a percent of total production peaked back in the global financial crisis and is yet to regain its upward trajectory. You're going to manufacture something less efficiently domestically. It means higher cost of production, higher goods, higher inflation, all things being equal. The second part of the equation is populism. The U.S. is moving more and more into a populist direction, and that can manifest itself in many different ways. It could be higher minimum wages, a redistribution of wealth from the top 10% to the lower 60%, but really what populism does is it creates a lot of demand for lower income households. More demand, less supply, higher inflation. And this was a key reason why you had the high inflationary 70s, which was Lyndon B. Johnson's populist war on poverty. The last part of the kind of bull structural higher inflation story is this one. You've seen a global labor supply glut over the last 4 decades, and that is starting to end. Now, one of the single most important economic developments over the last 4 decades was the rise of China and its integration into the global economy. China's working age population from 1990 to 2017 increased by 240 million people. During that same time frame, the increase of the working age population in the U.S. and Europe combined was less than 60 million. So it was 4 times the size of those 2 regions. Also, you had the fall of the Berlin Wall in 1989. It brought Eastern Europe into the global ecosystem, which is around another 200 million individuals. So with these 2 key events happening, you effectively doubled the labor supply force for the world, and it really put a lid on wage growth globally and also domestically as well. But this story is starting to come to an end, right? China is not as peak working age population has already happened in China. You're also seeing China wages move up much higher than it was over the last couple of decades. In fact, China has the highest wage growth in emerging Asia at the moment. But also, China is reaching the end of their internal migration from the farming communities in the West to the manufacturing communities in the East. So that's obviously going to be a headwind and potential reason for higher global wages. Also, the other reason is that dependency ratios are moving in the wrong direction. Over the last 4 decades, you've had more workers than dependents. Workers produce more than they consume. That's deflationary or disinflationary. Now with the graying of China, Japan, Europe, and the US, you have more dependents than workers, which is inflationary, all things considered. And with the supply of labor shifting down, that means labor's bargaining power was going to increase, higher wages, higher unit costs, higher inflation. So that's the bullish kind of structural story for higher inflation in a nutshell. Now, what are the markets pricing? I think the markets are pricing a very rational response right here. The blue line is what the markets are pricing for inflation over the next 5 years from 2021 to 2026. They're expecting an inflationary overshoot. It's close to 2.5%, and that makes sense because the Fed is purposely behind the curve. They're going to not raise rates until they see the whites of the eyes of inflation, so I think the markets have this right. But also I think interesting, if you look at the next 5 years, which is that gray line from 2026 to 2031, the markets are pricing inflation coming back down to 2%. Now, what's my view? Look, I know there's a genuine concern that we're on a path to a repeat of the 1970s, which was a period characterized as easy monetary and fiscal policy. But the key aspect of that time frame is that policymakers were willing to accept that inflationary rise, which anchored inflation expectations and created a self-perpetuating higher inflationary feedback loop. And I know there's a lot of monetary and fiscal policy today, but the big difference is that inflation expectations are firmly anchored because people are used to seeing prices stay low for the last couple of decades. And maybe more importantly, central bank independence is not in question. Also, the big difference between today and 5 decades ago is that there's much better measurement of long-run inflation expectations. We have inflation-linked government bonds. We have consumer inflation surveys. You actually have people who forecast inflation. These weren't things that were readily available 5 decades ago, and then the unanchoring of inflation expectations snuck up on policymakers, and that's not going to happen today. Also, I think there's an important point that there's no limit to how high the Fed funds rate can go, and the Fed can always get inflation stopped if it wants to, like Paul Volcker did in the early 1980s. A couple of other things that I think are important to note is that you have the Amazon effect. Consumers and businesses have never had an easier time comparison shopping. It makes it much more difficult for price increases to stick. Also, you have the ability to substitute labor. Since labor is the biggest part of a company's cost structure, labor is going up in an aggressive manner. Companies have the ability to replace labor with machines and then also robotics. And maybe the last reason is that if you look at the Fed's preferred measure of inflation, which is core PCE, only 40% of it is cyclical, which means in order to have a big overshoot of inflation, those cyclical categories are going to have to get very, very large. So not a very strong possibility of that happening. And the second reason, at core PCE, 20% of it is healthcare inflation, and healthcare inflation here in the U.S. is going to be depressed because of policy pressures over the next couple of years. So in order to get a 1970s style inflation, the only way that that's possible is if monetary policymakers lose their independence and they can become compliant to accommodating excessive fiscal policy. And I just don't think that that's a scenario that appears to be the case right now. So I agree with the market's interpretation here. I think the market may be a little bit complacent on the 2026 to 2031 measure that you see here. Maybe because of those structural issues, we get to 2.5% inflation, maybe 3% inflation. But again, the market doesn't look out 5 to 10 years. The market only looks out 6 to 12 months. And in the next 6 to 12 months, you're going to see a continued reflation of the U.S. economy, which has historically been very good for risk assets. So I would fade the inflation story here, at least over the next couple of years. So with that, that's all the prepared comments that I had. Maybe I can turn it over to you, Vinay, for see if we have any Q&A to be able to talk about.
Great. I'm always just so impressed with the thoughtfulness of you and Josh's comments and how much ground you're able to cover in 35, 40 minutes. So let's get to the Q&A. And again, as a reminder, For those listening, if you want to submit a question through the chat feature, you can do so. So let's go through what's been submitted so far. So first question was, I mean, gosh, if we were doing this a year ago, with all the uncertainty, I don't think we would have thought markets, either really on the fixed income or the equity side, would have been this robust. So I guess the question, given how many conversations you guys have with investors, Jeff and Josh, what do you foresee as shifts in or potential shifts in portfolio asset allocation? And obviously, so much of our comments were structured around the U.S. markets, but with kind of herd immunity and kind of vaccine implementation kind of far ahead in the U.S. relative to the non-U.S., what are you seeing as opportunities outside the U.S.?
Great question, Vinay. I think this is like a 100-meter relay race where, China was the first out of the gates. They handed the baton to the U.S., and now the baton is going to go to Europe and Japan and the emerging markets. So I think at this point, even though you can clearly tell I'm optimistic on the U.S. economy and markets, I think it makes sense to look at the international space because they look pretty attractive on a relative basis. I think Eurozone looks pretty attractive. They're going to be reaching meaningfully the numbers that they're going to reopen probably in June, maybe July, but the market is going to front run and sniff this out. I like the Eurozone because they're a global cyclical and value play. They're trading cheap. They're going to be a beneficiary of stable peripheral yields. And let's not forget the recovery fund is finally going to start to be implemented here in the summer. So I think the Eurozone is going to be a very good play over the next, call it 6 to 12 months because of all of those dynamics. I also like Japan as well from a similar vantage point. They're one of the most traditional global cycle plays also. And I think that, valuations are attractive and positioning is pretty light over there. But overall, I think it's time to kind of lean into that international trade for the next year because usually when you do see a pickup substantially of global growth, that's usually better for international markets. The U.S. will usually participate, but that international markets will usually lead. Also in the U.S., buybacks have been slowing. They're not as robust as what they have been in the past. So that's going to, kind of close the gap of U.S. EPS versus what you've seen in the international space as well. Also, there's a pretty large valuation gap, all things considered, between the U.S. and the rest of the world. So, and profit margins, since a lot of the international equities, they are getting more value-oriented. They have a lot more operational leverage. I think that their profit margins are going to start to accelerate much quicker than the U.S., which is all going to drive relative outperformance. So I think, if you're drastically underweight the international space, you should really start to think about, looking at increasing that allocation here. I don't know if Josh has anything else he wants to add.
No, I thought you did a great job,
Jeff. We just had a question just come in about, you had talked about Eurozone and so many people, right? Brexit's been around for 5 years now. Gosh, I think it was June of 2016 that we first started talking about this. Any incremental things that you would just overlay to those comments about Eurozone and Brexit and the potential impact? Would you separate out UK at all from broader Europe comments, either of you?
I would just say with the UK, I mean, a lot of the effects of Brexit have been priced at this point. It's kind of a known quantity. But the UK equity markets, they look attractive right now, but they actually don't historically do that well in a pure kind of global acceleration type of scenario. Usually the UK markets do well when you see a peaking out of global growth and they start to come down due to a lot of the companies in UK indices having a much higher dividend play. So I'm neutral on the UK. I think UK markets will do all right because they are attractively priced, but I don't necessarily think that this is the part of the cycle where they're going to outperform meaningfully.
Okay. So next question that came in, your slide 15 was really just an excellent summary of, I think, how you guys and how you're communicating to the investment teams at ClearBridge around U.S. corporate tax rates and the potential sector impacts. But I guess the question that we got that came in is, what do you think is really the net impact? We talked about, aggregate tax rates being low relative to the rest of the world, and you talked about the global companies, Josh. But when you're talking to the PM teams at ClearBridge, what do you think the net impact and, more importantly, the sensitivities of a tax raise, because it's really about expectations of what people are thinking. What would you say there in the downside risk on equities just from any change in tax policy?
Yeah, so I think and on an absolute basis, it's maybe like an 8% impact or so, which I think I said in the comments. A lot of it depends on how things play out specifically. So if we end up, if a bill gets passed, start there. If tax rates happen, then the second question becomes, well, what happens? Is it more GILTI-led, or is it more kind of domestic focused? That's going to impact the leadership and how that plays out. And then I think the other thing that we've been talking a lot about with PMs is how is this going to actually kind of flow through to stock prices more mechanically. So if you think back to 2017 when we got the tax cuts, the first thing that happens was stock prices went up and multiples rose. And then really over the next kind of 6 months or so, we kind of grew into that multiple as earnings came through, and stocks kind of moved ahead of earnings, and the net effect on multiples when we were looking a year or two later was relatively small. There were other things going on. If you try to isolate the impact of taxes, it was a little bit of a bump to PEs, but really not that much. So I think using that as a starting point, we've been trying to think through is, well, basically the opposite is going to happen. So PEs would come down, stocks would come down along with them, and then over time the earnings would get revised, and we end up with probably a slightly lower multiple on the other side of this a year or two later. But I think it's also important to remember that the corporate tax changes aren't, they're not being proposed in isolation. It's not that the stimulus plans, as they just said, they're stimulus plans, right? So on net, we're spending more money than we're proposing to raise. It's sort of how that footprint impact or maps out onto stocks. So I think that there's some equities that are going to be particularly unfavorably impacted, and then there's others that are going to have a net positive impact. So when we're talking about kind of a broad market perspective, I think it's going to be much smaller than that sort of 8% number that I just laid out. I think probably more kind of like the mid to low single digits from a kind of a risk perspective. So I know I've said it a couple times, but we're just so early in this process. The time frame for a potential first bill, if they end up splitting this into two bills like that's sort of currently proposed, the time frame for the first bill getting passed is kind of August or even September, given the congressional holiday that takes up much of August. So we're still 3, if not 4, potentially even 5 months away from the first part of this going into effect, and then even looking into year end or even next year for the second part if it comes to fruition.
Great.
And the one thing I maybe add there also, yeah, I do. I think it's important to just highlight. I think maybe in your initial comments, Josh, you had mentioned this, but in order for these packages to move forward, you need 100% of Senate Democrats to agree to it, and you only have a 4-seat cushion over in the House. And there's been a lot of pushback of the statutory rate going all the way up to 28%. Obviously, Manchin has talking about 25% being what he would feel comfortable with. But also with the cap gains tax doubling, there's a lot of House Democrats that are in competitive districts where either Trump won or Biden carried close to 50%, where that's going to be very, very unpopular. So I think obviously there's been a large increase of taxes that have been suggested, but I think ultimately, as Josh had alluded to, when you get through the sausage making process, that these are going to be watered down substantially, and that market impact, there's going to obviously be some, but it's going to be a fraction of what is currently being proposed.
Now, this question was pre-submitted, and I think we'll clearly know the answer based on how much of your content was based around this. So maybe address the second part of this. So question is, what factor do you think is more important to market sentiment in the near term, interest rates or currency or dollar strength? And obviously you had a whole section on interest rates, and I think inflation is a component on that. But maybe just talk a little bit just about your guys' thoughts, or if it's really a non-issue in the short term around currency and dollar strength.
Yeah, I can start, Josh, and maybe kick it over to you. I personally, they generally move with one another, but what I'd say is interest rate movement. If you look at the last 12 months, interest rates have really been the driver of market leadership, and I think that's going to continue to be the case over the next year. In my opinion, the only way that the dollar really becomes a dominant driver is if the Fed decides to engage in yield curve control. The ECB over in Europe is doing closet yield curve control. They're seeing it over in Australia. but the Fed has yet to move in this direction. And the only way that I think that you will see yield curve control is if you see a disorderly rise in interest rates. Could happen from a failed Treasury auction maybe, but I really just don't think it's a high probability. But if you do engage in yield curve control, it's going to anchor yield, so there's really not going to be any information value there, and really the release valve for investors is going to be the U.S. dollar. There's a legendary economist that recently passed away that said a country can manage its monetary policy, its exchange rate, and its capital flows, but you can't manage all three of those simultaneously, which means, again, if you engage with yield curve control and you're managing the capital flows, of course, the exchange rate is going to be the one that bears the brunt of it. But again, I think just kind of given where we are, I think interest rates are the most important driver. Josh, I don't know if you have a different perspective.
No, I agree. I think they tend to be pretty related trade from an equity perspective. I also tend to think about interest rates first, currency kind of as a second order impact, just given that I tend to have the view that over longer periods of time, currencies tend to follow interest rate differentials globally. So again, barring that scenario you laid out around a yield curve control type of environment, I think that I'd be focusing much more on interest rates than currency.
Yep. So speaking of interest rates, Treasury Secretary Yellen, kind of almost had like I said it, but I didn't really mean it comment. I've seen some memes in the last couple of days that, taking the few good men, you can't handle the truth, about this. But I think we've all become Fed watchers. And obviously in your role, I think a lot of people are looking to your thoughts about, do you expect to see hawkish comments from the Fed? And more importantly, what data points do you think they're going to pay most attention to here in the near term?
I definitely don't think she meant it. I think it was, she walked back those comments fairly quickly. But I think, honestly, the three most important words for investors right now from a Fed standpoint is substantial further progress. The Fed has said that they want to see substantial further progress on their employment and inflation goals before starting to talk about tapering. Like Powell said, he's not even thinking about talking about tapering at this point. So I think that the Fed obviously will start to talk about tapering, I think, is the August FOMC meeting. I think when you're going through the reopening here, it's not a real gauge of what's the trends growth of the economy. You'll probably start to see things slow down as you get to the middle to late part of the third quarter, and then you can have a realistic expectation on what's that path for inflation and employment. And I think the August FOMC meeting is the perfect time frame for them to start to just message that they're going to be talking about tapering, which I think will likely commence in the beginning part of 2022 and follow a similar path of what you saw back in 2013, where you're basically buying $10 billion per FOMC meeting less in Treasuries, $5 billion less in mortgage-backed securities, and you'd eventually get to zero bond buying over the course of a year or 8 FOMC meetings. But, if you talk taper, that's going to be the equivalent of around 75 basis points of rate cuts using Bernanke's math back in the global financial crisis of QE and 600 billion of it being 75 basis points. The numbers are a lot larger right now, but again, so is the economy and money supply. But the markets will start to price that in, and I would expect to probably see some volatility in the markets in the late third quarter as they try to digest and then price in this tightening of financial conditions.
So last question we have, I feel like this, maybe it's just work from home, but maybe it's just generally the markets, like we're living in dog years. This feels like so long ago. But the question was, will issues like the Archegos losses kind of, what are the underlying currents in the system, and could that potentially lead to the next recession? What would you guys say on that question?
Never say never, but I think it's pretty unlikely. I think this was really a kind of a risk management failure, and it happened, but it didn't cause a systemic issue, right? No banks had to get bailed out. There might need to be some capital raised, but we were able to kind of withstand a very big loss. But just putting in the context of the broader economy, the numbers I've seen, we're talking $10 to $20 billion in losses against a $22 trillion roughly economy, so like 1,000-fold larger than the high end of that estimate. Not trying to make light of $20 billion. Obviously, it's quite a bit of money, but just from a systemic risk perspective, it's not that large. And Fed Chair Powell was actually asked about this at the FOMC press conference a week or two ago, and he kind of echoed the same thing. I think that as an industry, banks are tightening risk controls. we're rethinking some of the processes. Regulators are looking into this, and they might ultimately make some changes. And I think ultimately that means we're not, it's less likely to happen the exact same thing happen twice. Generally speaking, I think we do a pretty good job of maybe you could say we're fighting the last battle sometimes, but as broader financial industry, we tend not to make the same mistake twice. Doesn't mean a huge hedge fund blowing up can't cause some sort of issue, but historically these things tend to be contained within the financial system. Long-term capital management was a huge blow up, but it didn't cause a recession. It's a very high profile example. And even think back to the global financial crisis, those two hedge funds that Bear Stearns blew up, they weren't the cause of it. They were kind of a symptom where the housing market was blowing up, and that was kind of dragging those funds down. And ultimately that wasn't the kind of spark that lit everything. So one other quick thing I just echo on the prior question around did Yellen mean it or not. I think I don't want to say her comments were taken out of context, but it seemed kind of, when I was listening to what she said, it sounded very much like she was saying it was kind of a hypothetical situation where she was saying if this happens and then if this happens and then if that happens. It was sort of like if everything goes right, we're going to need to raise interest rates at some point. And it was not necessarily tomorrow. I think she was kind of also talking about pretty far in the future, right? If stimulus gets passed as it's kind of proposed, if the economy continues to recover, if all these good things happen. And when you reframe it that way, I think it's a little bit more clear that yes, that's a pretty fair and logical statement to make. I think I'd take it out a little bit of context. And also there were, I think, 6 or 7 Fed members that came out, yesterday and in the aftermath that sort of said, look, we're not even close to doing this today. Longer term, different story. But just wanted to make that point as well.
So the last question I'm going to ask before we get to kind of closing is something that brings a smile to my heart. So most of you, at least internally at ClearBridge, know I'm big on 2-minute drills. And so, Jeff, I'll let you do this. So if somebody asks, you guys covered a lot of ground in these last 55 minutes. How would you summarize it? What would be your takeaways for the listeners, kind of, if you could do that in 2 minutes?
Yeah, you're going to get a whiff of inflation here, but it is transitory. Rates are going to rise, but it shouldn't hurt equity markets. It should define leadership. So lean into that value cyclical trade. I think there's more to run there, especially considering that earnings estimates have been revised higher for that cohort and will continue to be revised higher as we move through this period of growth. And not to get too defensive. At this point in the market cycle, equity markets grind higher. You see a lot more volatility. But again, we're so early on in this economic cycle, and the fact that the Fed is not going to get in the way, which they historically do in tightened financial conditions, it means a hot economy. It means hot financial markets. It means risk on. So that's basically my 45-second pitch, viewpoint. I'm summarizing our comments today.
Awesome. So unfortunately, I think we're out of time. I want to thank Jeff and Josh, as always, for their thoughtful insights. I want to thank the participants for their attention and asking all the questions. Honestly, probably the most frequent question we got is how do I get access to some of this information and specifically the slides. So if you want a copy of the slides from today's presentation or want to subscribe to the ARO program going forward, please don't hesitate to reach out to your ClearBridge representative and we will follow up directly and get you a copy of the slides. Lastly, a replay of this call will be emailed to all participants and people who weren't able to dial in live and should be available on our website in the next 48 hours. With that, good day and good luck, and thank you again for your attention on today's call. Have a great day.